Hello, welcome to Sketch Ed. In this video, we will be talking about monetary policy and the topic within it. The first topic we will be talking about is the monetary policy itself. So what is a monetary policy? A monetary policy refers to the actions taken by the central bank to influence the general price level and the level of liquidity in the economy. Monetary policy aims at encouraging spending on goods and services by expanding the supply of credit and money by lowering the policy rates, bank rate or repo rate, lowering the reserve requirements and purchasing the government securities from the market. The objectives of monetary policy: first, economic growth, increasing the capacity of an economy to produce goods and services. Second, full employment, economic situation in which all available labor resources are being used efficient way possible. Third, price stability, price level where the supply of money equals demand for it is the equilibrium price. Fourth, neutrality of money, the change in the stock of money. Fifth, exchange rate stability, which a currency value is fixed against the value of another single currency. It is important to control the supply of money because some of the major economic concerns, such as inflation, often result from an excessively strong expansion of the money supply.
The script, it's mine. Expansionary monetary policy. This policy aims for economic growth, increase the money to boost economic activity, lower interest rates, and reduce unemployment. If the government aims businessmen to make businesses, they will grant expansionary monetary policy, giving them lower interest rates to loan from the banks to create businesses so that the people will be employed and have the money to buy goods and services. In this way, the people can make more money, and this indicates that the economy of a country is growing. But the more money, the more tax. The tendency they will have to spend more and save less. The more they spend, the more demand than a supply that can cause inflation.
Contractionary monetary policy. The effects of contractionary monetary policy is that it decreases consumption and investment spending. It also decreases the overall demand for goods and services.
Did you know the bank creates money to fractional reserve banking? When you deposit, the bank can keep a percentage from your money and reserve it, and that certain percentage can get loaned by other people, but still return your money as it was when you deposit it. A central bank has at its disposal three tools of monetary control, namely reserve requirements, the discount rate, and open market operations.
Hello? I am under the water. Where is Lovely?
I don't know.
Hey, it's my script. Reserve requirements refers to the percentage of bank deposits and deposit substitute liabilities that banks must set aside in deposits with the BSP, which they cannot lend out, or the amount of funds that a bank holds in reserves to ensure that it meets the liabilities in case of sudden withdrawals. Reserve requirements are one of the three main tools of monetary policy. As an example, assume a bank had 200 million pesos in deposits and is required to hold 10%. The bank is now allowed to lend out 180 million pesos, which drastically increases bank credit. In addition to providing a buffer against bank runs and a layer of liquidity.
Discount rate. The effects of discount rate. It increases the discount and makes it less profitable for the banks to borrow money. When the banks reduce their borrowing, the reserves of the bank are reduced. Discount rate is an interest rate charged by Federal Reserve banks when a bank has experienced a big withdrawal or many loans. They will have to borrow reserves to increase its reserves account. The cost of borrowing is called discount rate. Higher discount rate would lead to banks to decrease their lending. A lower discount rate would encourage banks to increase their lending.
Open market operation is the sale or purchase of government securities by the BSP to withdraw liquidity or inject liquidity into the system. Open market operation consists of repurchase and reverse purchase transactions, outright transactions, and foreign exchange swaps. This is carried out through the repurchase facility and reverse repurchase facility of the Bangko Sentral ng Pilipinas. Conversely, the central can decrease the money supply by selling bonds to the public. People pay for these bonds with their holdings of bank deposits. They make withdrawals from the banks. These withdrawals decrease the quantity of reserves, reduce the amount of lending, and decrease money supply.
The Bangko Sentral ng Pilipinas, or BSP, is the central bank of the Republic of the Philippines, established on 3rd of July 1993, pursuant to the provisions of 1987 Philippine Constitution and the new Central Bank Act of 1993 BSP, enjoys fiscal and administrative autonomy from the national government in the pursuit of its mandate responsibilities. BSP, or Bangko Sentral ng Pilipinas, preserves the confidence of money as a thing of value and essential of the economic system. Once the trust is broken, money ceases to function as it should be, as a vehicle of economic activities and pillar of the price system. Two objectives of BSP: maintain price stability conducive to balanced and sustainable economic growth, promote and preserve monetary stability and the convertibility of national currency. Responsibilities of BSP: the BSP provides policy directions in the area of money, banking, and credit. It supervises operations of banks and exercises regulatory powers over non-bank financial institutions which quasi-banking functions. BSP functions according to the new Central Bank Act: liquidity management, currency issue, lender of last resort, financial supervision, management of foreign currency reserves, determination of exchange rate policy, other activities. And that will be all about monetary policy. Thanks for watching.